Hi, I'm Sai from Sai's Property Academy and Gracio Sourcing and Lettings. I'm going to give you a little bit of a background about me, and then we'll dive into a Property 101 basics on how to start in both deal packaging and sourcing for buy-to-let lettings. I've been doing property for about 10 years now. I started out as a sparky, or an electrician to people that don't know the short form of that. I left school at 17 to train, did my apprenticeship, took me 4 years. I did that at Doncaster College up in the north, and just on literally, it was my 21st birthday and I was just qualifying as a sparky. I got my first full-time sporting contract, so I played rugby union. I went to Coventry to go play rugby union. I was a bit of a late developer. I'd never really played a lot of rugby at a high level when I was younger. I worked really hard. I'm not the most talented human being in the world. Everything that I do, I have to work quite hard at. I managed to get a contract down in Coventry. When you hear people saying professional sport, maybe barring footballers, there is very little money unless you are the top level. So I was paid £700 a month to go play professional rugby. So we trained Monday, Tuesday, Wednesday mornings, Thursdays off, and played Friday nights normally at this club that we played at there. So I never earned a lot of money playing rugby, but I really, really enjoyed what I did. So it was a bit of a dream come true. I lived with a friend at the time who let me live there for free while we renovated a house. And that was really probably one of my first starting points into property. I'd become an accidental landlord just a little bit before starting in property when I bought my first house in 2007. And that was pre sort of great financial crisis crash. They would give it money to anyone, and I was only an apprentice electrician, and they would give me enough money to buy a flat. I then sort of kept that for a lot of years, rented that out. So as we did the house at Coventry, I realised that we enjoyed doing property, but sort of parked it there as I went to New Zealand and played rugby in New Zealand before coming back and going completely different to the electrician and rugby careers that I'd had, and started a cafe. So I opened a restaurant in Huddersfield, which is where all my family are from, and did that for 6 years. That was one of the hardest things I've ever done in my life. There was no money in rugby. There's definitely no money in hospitality. And I think I heard a famous quote. It's like, if you want to make £1 million in hospitality or having a restaurant, start by having £2 million and lose it through the restaurant. It was an awful money making thing. I love hospitality. I love my food and drink. I love my coffee. I'm mad into my coffee now. I was once the 20th best barista in the country, so that is probably one of the saddest facts that anyone could ever hear. So halfway through that, it was a bit of a penny drop moment. I read the book Rich Dad Poor Dad, which is normally the starting point for most entrepreneurs' journeys and most property investors' journeys. If you haven't read it, it was basically assets pay for liabilities is one of the sort of main lessons from there. So invest your money in assets, and those assets will pay for your liabilities. So in our case, if we could buy 2 or 3 buy-to-lets, it could pay for the fancy sports car if you wanted that. That was the penny drop moment for me, and that's when we started looking at investing in property a bit more full time. And we started out by buying some HMOs, which I did with a friend who we'd renovated the house in Coventry with. We did 2 together. We renovated them from 3 and 4 bed properties respectively into 6 bed HMOs each time. Huge renovation jobs really for people that are starting out. I still had that little bit of experience of being an electrician and understanding what happened on site and what the renovation process were. However, both projects massively overrun on cost. We still made a go of it, and actually the rents we got from there were fantastic. And those 12 units were great rental properties for us. From there, I stepped into new builds, which was a step that I took too soon. It was a big step up. But in that time, I learned how to raise finance. So from here, I've learned to raise over £2 million in private finance and a lot more in then development finance and bridging finance and mortgages since. So I learned how to find investors, how to speak to investors, and what the investors want and the agreements. Some of those agreements haven't always gone well, and I've also learned how to manage those relationships for the good and the bad. And I've not always done it perfectly, but hopefully that's what I can carry on teaching when I do Sai's Property Academy. So from there, we did 3 new build sites, totaling 29 units. We did that throughout COVID, which was a really difficult and challenging period. I remember one site completing the day before lockdown, which was absolutely brutal. We didn't realise probably the implications that would have on costs and times. Now, the building industry never shut down through COVID, so we carried on going. Materials were really hard to get hold of. Materials went through the roof, and then labour in turn, as in contractors, took ages, and they were expensive because they were so busy with what they wanted to do. Everybody had an extension on the house or the kitchen or the bathroom doing because no one was spending their money on holidays or going out. So it was a really sort of difficult time to do any new build. House prices went up, but not enough to absorb some of the costs that we got. So yeah, that 3 or 4 year period was a real brutal learning curve for me. I've managed to get out of those projects now, and we finished them and they're tenanted and or sold. But what I did learn through the sort of 6 years prior to this was that the humble buy-to-let is one of the best places to start, one of the best places to continue through. So I always think that now everybody should have at least 10 buy-to-lets before they do anything else, serviced accommodation, HMOs or anything like that. We've also done a 28-bed serviced accommodation unit in Manchester. That was a really busy time. That was really great, actually. I enjoyed that as a project. But again, hospitality, it's a busy business to be in. And I really have come back round to the sort of deal packaging and buy-to-let investment side of stuff. So what I am going to go and talk through, hopefully now over the next sort of 30 minutes or so, is step by step in terms of how to start investing in buy-to-lets. Now that I've told you a bit about myself, we are going to dive into how to start investing in buy-to-lets. Now, as I've mentioned before, buy-to-lets and deal packaging, you're doing the same thing. So whether you're buying the buy-to-let for yourself or whether you don't have the capital to buy the buy-to-let for yourself, you might as well sell it on to somebody for a fee, usually around £5,000. There's various ways of making money in that process. However, we need to start with an investor. Suppose this is if you aren't lucky enough to have equity in your home or some savings already. But even if you have those things, normally you need to go to a wider market to invest or get investors to invest in your business one way or another, certainly if you want to scale. So finding an investor is something that is often talked about, and where do we find them? And like I say, there's two elements to this. They could be to invest in your business from an angel loan perspective, or it could be to buy your product, as in like they want to buy a house and they want to pay for your service for finding that. So number one is network. So it's the first place to start, is you want to go to your network. And that is normally your phone book. Friends, family, people at the gym, people at places you spend a lot of time at, golf clubs, bridge club, chess club, whichever places that you go to, the kids' swimming clubs where you sat on the sideline and you've got a chance to speak. You want to build that. That's one of the most important things in anything, in any industry, and discuss and talk about what you are going to do. So you are hopefully going to invest in property, or you are going to deal package for them, but we want to speak to your network. The second thing to do when looking for investors is have a prospectus. We want to be able to tell people what they do and give some literature to somebody. So you aren't ever going to go to somebody and say, please give me 50 grand, or I'm going to buy you a house for 100 grand. You are going to need to give them an outline of who you are and what you do in a bit more depth. As we said, we're going to our network first, so they hopefully have a bit more of a rapport and understand you, but they might not understand how your business works. A lot of the time, I do this all the time, is I presume that people know what I do and how I do it, and even down to how to buy a house. I've probably realised over time that a lot of people may never buy their own house, and actually if they do it, they might only buy it once or twice in their life. So if you're going to do something once in your life, you're probably not going to be great at it and or know the intricacies of doing it. So it is important that we break down and lay down the land in terms of what we do from a business basis in our prospectus. Once we've sort of exhausted our network, we've got our prospectus ready, we're going to start looking in the right places. So we're going to go out and look for investors in certain places. So that might be networking meetings, business networking meetings, property networking meetings. It might be you might decide that you want to join a golf club or a high net worth club, people that have sports cars or like sports cars, hang around in those areas. If you've got an interest in watches, hang around in watch groups or wherever that might be. This day and age, there are groups online and in person for absolutely everything. But if people have an interest in something and you have that connection, and certainly if it's a higher wealth product, as in, like I say, cars, golf, or watches, for example, then we want to start looking at those places. We want to start positioning ourselves in those places. One thing I always say is a lot of people say get involved in property networking events. I would say maybe go to business networking events where there are SMEs or small businesses that have a bit of capital in their business that they're looking to make more money on, and they don't have the time or the knowledge in terms of doing that. What you're trying to try and do and explain is you're going to do a lot of the work in property to help investors get a return on it, whether you're buying it for them or whether they're investing in you and your business. So look in the right places. Number four, this is a big one, social media. So social media these days isn't just posting about your cat or your holiday online. Social media is a strategy. It is something that needs to be well thought out, but it's something where you just need to start. No one that I've ever met is overly comfortable about talking about their life online. Everyone I speak to is like, it's really hard. I'm not comfortable doing it. I don't like facing the camera. I don't like doing, people just like posting their feet on a sandy beach and that is it. Social media these days is an incredible way to reach people, an incredible way. And I think everybody understands that. I also have a lot of people who say, I've missed the boat on social media. I've missed it on YouTube. That certainly isn't the case. Social is not going anywhere. There may be another platform. There might be the next big thing. But we have to start doing some social media if we want to build our brand awareness. And the brand is you. The brand is me. The brand is anybody personally that wants to start any sort of business. And certainly in this case, we're looking at building a property business. So social media is key for raising awareness and hopefully starting to find investment. One thing I'd also say about social media is people expect to post something about your property or about the deal that you're doing and get instant sort of feedback. Sometimes as well, if I'm talking to somebody, say, at a golf club or whatever that might be, or at the gym, they're not necessarily going to give the game away straight away, but they are going to go look at you online. They want some proof, they want to understand what's going on, and they want to know who you are and what you're doing. So they'll look straight away on your social media, more so than a website these days. Step on is be clear in your proposition. So this links back to the prospectus a little bit, but we want to be clear in the proposition and what we are offering. That will give the investor confidence. So if you're starting out for the first time, you may not be experienced, but the investor is investing in you. So again, whether they're buying a property through you or investing in you, they are buying into you. So it is important though that you have a clear proposition to offer them so they understand what they're investing. So it's you as the basis, but what are their returns from an angel investment standpoint? What are their returns on a property standpoint? Where are you investing? What are you investing in? What are you offering them? And what are you offering in return? If you are clear on those points, of which we'll go through some of them in this video, that will give them a better understanding of where they're going to go and where they're going to invest their money. And then number 6 on my list is get a mentor. Mentors and training sometimes is a murky world and a bit of a sort of dirty word these days, but it's easily been one of the best investments I've ever made in myself. And everyone I speak to, if you find the right mentor and the right mentorship program, is absolutely key for getting going. You can find loads of stuff on YouTube. You can find loads of stuff for free these days. But having clarity and someone to guide you through the process that has done it and help you is absolutely key. So when you're trying to find investment, being able to sound a mentor as a sounding board, mentor to help you with agreements, where to look, how to look, and what to do for social media, for example, or how to help with your prospectus is absolutely key. So I would always do your research and due diligence, but have a little look at getting a mentor. It will help you get your investment started from the top and working down. Having that mentor is absolutely key. So that is a starting point on where to find your first bit of investment and your investors. So we've worked out where we're going to find our investors. Now we need to understand the process before we go into the basics of finding your perfect buy-to-let and how to start the company, etc. So the process is important. We're going to go for sort of from start to finish, and then we'll go sort of back around into the sort of basics of how to start in property, which you can use as a real sort of stepping stone into understanding where to start and how to start, which is a question I get loads, where I don't know where or how to start. So the process is, there's 2 parts to it. Like we said, we either need the buyer. This is from a deal packaging standpoint. And for me, if you come onto Sites Property Academy, or anybody goes into Sites Property Academy, we are always working out how to find a great buy-to-let deal, and then whether we raise the finance ourselves or whether we can sell that on for upwards of 5k a month. They are the things that we are wanting to teach. Super simple, super basic, but we want to be able to teach those. So we need a buyer. I could probably put investor there. It's sort of same thing. And we want a seller. So this is a deal that we want. So the first 2 parts go simultaneously, and then sort of side by side, and then we'll pull that in together in terms of the last part, which is where we put the buyer and the seller together, or the investor and the seller together. So buyers, we need to market and push ourselves out there. So we've spoken about that previously in terms of where to find the investors and where to push yourself to find those. We want to qualify them. So one thing I'd always say actually is that anybody that comes to you that says, I've got some money or wants to invest in property, doesn't mean that everybody is a good fit for you. You've got to work out who is a good fit. They need to be good people. They need to be true to the word. They need to be, if things go wrong, you want to be able to go speak to them. You don't want anybody that's got some money in the bank just because, especially when you're starting out, you're desperate for that investment or you're desperate to sell that deal. Make sure you qualify them as good investors first. Contracts, make sure you have the contract for either the investment or for them to buy the property, your services. So it's important to get the contractors sorted out. So that is the sort of first process of finding the investor and the buyer. Same time, you're looking for deals. So simultaneously, we are looking at the market. So we're either marketing, as in sending leaflets out, direct to vendor. There's lots of ways of finding a deal, and I have a list and a sheet for that. Analysing the deal, so we're working out what the rental income is, whether we're buying at discount, how much the refurb is. We're analysing that quickly in a bit of a desktop before we go look. We're making an offer, and we find out that the offer's accepted. We pair the investor and the seller together. That's where we get to sale agreed. So in that case, it goes into sort of case management, which is effectively conveyancing, where the seller, as in the property, and the buyer are put together at that point, and you're sort of in the middle helping the case throughout the process. Once the property's purchased, we're going to go potentially through a refurb. Not always. Sometimes you might buy a property at discount that doesn't need a refurb. It might be a different motivation for why the property's been sold. And at the back end, we are going to let out. So we've got a bit ahead of ourselves because in the next few videos, we're going to work out how to really sort of find those deals. Now we've worked out how to find the investors, and what the basics are is sort of setting that up. But the process is very simple like this. You want to do this hand in hand. You always need the investor first. That is one rule that you need. But simultaneously, you do need to be having deals and looking at deals in the background. So you have the knowledge of what you are doing. You have the language to be able to talk to the investor. And then so when the investor is signed up, you are ready to go, and you can really sort of dive in and get something bespoke for them and or for you. Sort of winding it back a little bit, these are the 4 sort of basic steps to starting out in buy-to-let before we even really start looking into deals and how we analyse stuff. But there is a sort of a little bit of a step-by-step process of really getting started in this and where to start. So, number 1 is set up a company. So we're going to set up a limited company. So 9 times out of 10, 9.5 times out of 10, it is the best way to buy property these days. Some people might disagree, say you can still buy in your own name, but there is a thing called Section 24 tax, which was brought in a long time ago now, that you'll get taxed heavily buying in your own name, and it doesn't really work so well. So we're going to set up a limited company. So that'll be for the same, whether you're investing for yourself or whether you are going to deal package and sell it on to other people. We will set up a limited company. There are a few steps within that which you can do, but you can do it online for yourself. You can get an accountant to help you do that and make sure you've got what we call the right SIC code, the right SIC code, which basically means you're trading under the right banner. But once we've set that company up, that is part 1 of where we are going to go. Part 2 is we're going to check out lending options. So this is if you are going to buy for yourself. We want a clear idea on how much money is going to cost. So the great thing about property is we can leverage banks' money. So we're always going to need some investor finance to buy property because we need deposits and we need refurb money, we need stamp duty fees. But we're going to work out what we can get lending back end. This will help us with our analysis, and this will help us with working out how much profit we're going to make. So when I say lending options, it is literally what rates are available at the moment in a limited company. There's a wide range, and at the moment we're probably sitting at between 4.5-5% per annum to borrow banks' money. So if you were to borrow £75,000 from the bank, it would cost you 5% per year. Lending in property is 9 times out of 10 interest only. Very rarely is repayment when it is from investment property. So you just need to work out what that would be over the year and what your outgoings will be, and then obviously how much profit you'll make once you know what your rent is. So your lending options are important to have an eye on those, have an eye on the market and what's going on, because they have fluctuated a lot recently. Understanding that will help you with your investors. It'll help you buying yourself. It'll help with deal. Number 3 is work out your strategy. So we want to work out what our strategy is. If you're here and you're looking and you're speaking to me, our strategy is the buy-to-let. There is a sweet spot for buy-to-lets in anybody's area close to where they live, but we want to buy humble buy-to-lets, simple, low risk. They're not incredible for cash flow day one, but we aren't looking at a cash flow business. We are looking at an investment business. So it's really important that we get that in our heads, but our strategy is that. So we want to look at from there what our area is, what our tenant type and what our demographic is. So for example, we have a mix. We're looking at blue collar workers, i.e. people that work in sort of factories or warehouses. That tends to be some sort of overseas workers a lot of the time as well. But they also have some white collar workers that are close to the city. So young professionals, people starting families. We want to work out our strategy as a real important part. That is point 3. And then number 4, for now, is area. So we want to work out where our area is. So I invest in Yorkshire, but Yorkshire's a huge county. But I have 5 areas that I really niche down into and work out what I want. So your area needs to be around 45 minutes from your house, ideally, so you can either manage refurbs, look at the properties, any sort of emergency problems you can go check out. You want to know what the infrastructure is. You want to know where people are working, what they are doing, what the local economy is like. So for example, for our areas, we're looking at Huddersfield, Barnsley, Leeds, Wakefield. They have great commuter routes. They have the M1 and the M62 is really close to them all. The council is spending lots of money on the town centre. So Huddersfield has a university. Barnsley has a lot of money being spent on the infrastructure and the town centres themselves, which drives people there. There's also lots of warehouses and factories that have been opened because it's close to the M1 and there's lots of space for those to be built, which is driving lots of people into the area for work. That is a really basic sort of economic point in terms of supply and demand. So more people come into the area, house prices goes up because we haven't got enough housing. So Leeds is obviously a huge city that is growing. We try and find the sweet spots in those areas of up and coming areas as the city gets bigger. So for you or for anybody looking at this, we want to find the right area where there is big tenant demand and there's going to be big growth over time. The other part what we're looking for is sweet spot in terms of pricing. So what we want to try and look at is we look for stuff that is above an 8% yield. And again, we can go into the numbers and the terminology, what they mean. We're looking, for us personally, we look at 2 and 3 bed terraced and semi-detached houses, freehold. We look at them anything between £70,000 and £140,000 because we know that then the rents work for those areas that we're looking at as a bit of a sweet spot. And we have lots of people that are interested in buying at that price point. Where you live might change a little bit. You might be looking at the £200,000 mark. You might be looking a bit cheaper, but probably unlikely. But you want to find those little sweet spots where we have a mixture of discount, i.e. stuff that needs adding value to, refurbs, what have you, yield, and sort of net rent. And they all sort of go hand in hand, but they're the bits that, they're the sort of, if you get the yield right, the net rent sort of follows, but they're the bits that we look at, and we're looking at sort of 100k either side of those bits. That's our real sweet spot where we look for. But they are the 4 points to get you started in buy-to-let. So we've worked out our process, we've worked out our area, we know where we're going to buy, we know what we're looking for. Our shopping list is simple, but now we need to find a deal, we need to negotiate on it, and we need to secure it, which I will have down at the bottom of this list. So the next sort of 10 minutes or so, I'm going to explain to you very briefly how we look at the numbers, how we negotiate and speak to agents. And there are probably about 15 different ways of finding property, but very simply, when we're starting out, we're going to look at the online stuff, the portals, the right moves, find our deals, because that is where 80% of property is sold. So we're really going to look at those first, certainly when we're starting out. But we want to work out now how we get to our offer and what we are going to offer. So number 1 is end value. So we want to start at the end and work our way backwards. So say we have seen a property on a street that we know relatively well, and it's tired, it's knackered, it's either probate, i.e. Somebody's lived in there that's a bit older, that's lived there for a long time, or it just needs some work, it's just been unloved for a while. So we want to find out what the end value will be once we've done up the work. So we'll use some numbers examples. So say we can say it's 150k done up end value. That's what we're going to try and work towards. So then we want to try and work out the refurb. So again, if you're not experienced with this, we're going to have to speak to some builders. Some people are great at refurb, some people aren't. It's all of part of what I sort of show and teach and help you with, is how to get to the numbers and work out what we're looking for in refurbs. We have a little cheat sheet, like a little check sheet, when we go view properties in terms of what it's got, what's the sort of main cost going to be. So we're always looking at boilers. That's really important. We're looking at roofs, we're looking at damp. They're the big costs, and then you go into kitchens, bathrooms, carpets, painting. We tend not to do big extensions or go up into loss very often. We might reconfigure a house. That's relatively simple. They're stud walls. So there's a few ways of adding value and how we look at it, but refurb, that's what we're going to do. So say the refurb is 20k. We're then going to look at buying costs. So buying costs are things like stamp duty, land tax, which is a 3% surcharge these days. So anything under 250k is no stamp duty, but you have to add 3% onto that, as it is normally a second home and an investment property. There are valuation fees, there are legal fees, and depending on what you've done and how you've bought the property, whether you're selling it onto somebody, whether you invest it for yourself and you got it for someone else, there may be a sourcing fee in that, or for someone to find that property for you. But on this case, we're going to presume that we bought it for ourselves. We're probably going to look at about 6k worth of fees to buy that from sort of stamp duty. And obviously that fluctuates depending on what you actually have the offer accepted at, because the stamp duty is 3% of your purchase price. So you've got your buying costs, you've got your refurb. We then want to try and factor in a little bit of discount to make ourselves a little bit of margin. So we want to work out some discount on that. So normally anything between 10 and 20% is what we have on our little spreadsheet when we're working out some discount. You're going to really struggle to get 30 or 40 or 50% discounts off stuff. It's just really difficult. The market is relatively settled. There are buyers. You're just going to really struggle to get the old, what I call unicorn deals, where you get huge discounts and pull out, unless you really look at it. But we also just want some discount where we're creating equity, and we'll let capital growth do the rest over time. So once we've factored all this in, we have our offer. Once we've deducted these, worked out our discount, we're looking at making an offer on this property, this imaginary property, at £105,000. Just guessing, this property may be on at £120,000, £130,000. It's a theoretical, mythical property. But that is the offer that we are wanting to make on that, to factor in all our costs. Now we've found ourselves a deal, we also want to make sure, before we make our offer, that when that property is revalued at 150k or worth that our rent sort of not just covers that, we make money on that. So we will look at a sort of an 8% yield in that. And yield is simply gross rent divided by that price. We can go into rent on a separate video, but that, if we can work that out really quickly, the rest of it should sort of fall into place, a bit sort of like dominoes. It will fall into place and your net rent will be okay. But this is more on sort of acquiring the deal, but we want to make sure that that's right before we make that offer. So at this point, we go speak to Mr. or Mrs. estate agent or vendor, and we're going to negotiate the numbers. It's likely that they've got that on the market for a little bit more money than that. Very rarely do estate agents A, factor in refurbs, but B, factor in any discount. So it's likely that it'll be higher than that. But there are 3 points that you really want to press to an estate agent or someone that's selling that will enhance your position. So if we are investors with cash in the bank, or we have a guaranteed seller, as we spoke about earlier in terms of the process, we want to give the estate agent and the seller, the other side of the estate agent, guaranteed sale. So in this market, people want guarantees. They don't want maybes and it might fall out of bed in a few months or whatever. We want to be able to guarantee that we can buy that property. That gives people confidence. So we've got a seller, we've got the money in the bank, we can guarantee buying it. Number 2 is we are investors and there is no chain. So a chain is where there are lots of people buying different properties further down the line, effectively, that affects your sale. So first time buyers are buying, they're buying off Mr. and Mrs. Smith, who are buying off Mr. and Mrs. Jones, off buying Mr. and Mrs. Firth, and those if one of those chains doesn't complete in time, or one of those parts of the chain, it delays the whole chain. I've heard of people waiting years or a year for things to happen because lower down the chain, things aren't happening quick enough. As an investor, there's no chain. It's just you buying a property from a seller or a vendor. So that gives you or gives them confidence that it could be done in anything from 6 to 12 weeks, depending on the conveyancing process, depending on your lending and where you're at. But that speed should enhance your offer on there. So the third part of when you want to speak to an agent is not just that you can guarantee the sale, not that you should have no chain, is you want to explain to them, some don't care, but you want to explain to them very briefly why you've come to that offer. So don't just go in and go, it's 105k, take it or leave it, phone down. We want to let them know why we've come to that offer. Maybe use that comparable that you've got on the street that you says, there's a nice one that's done up down the road at 150 and we're going to do X, Y, and Z to it. Explain that to them. Explain how you've got there. Explain that you are an investor, so you need to make some margin in it, but also the reasons 1 or 2 is why you think you should get that little bit of discount in there, and be really open with them about why you've got there. Don't just put the phone down and say, that's it, take it or leave it. There's 2 sides why that was important. A, you're going to build up rapport because you're having a bit of a better conversation with the agent. They understand your requirements and what you're after. Ultimately, they go on the commission. They want the best price for their client, but also they want to get them off the book. So they want to sell properties as much as they do, or as much as they can, and they want that guarantee as opposed to stuff dragging on or being sat on the market for ages. So explain to them how you've got to the offer. It's likely that you will never get your offer, or not never, but it's likely that you won't always get your offer accepted first time. They'll come back with a counter offer or they'll just straight reject it. What we do is we put that in our pipeline and we follow that up every month. We bought one recently for a client that we were looking at for 4 months. We had 3 offers prior that were rejected, and we eventually waited and got it snapped up. So then you have the deal accepted, you've bought your first buy-to-let, or you have your first buy-to-let in conveyancing, you have it for your investor, and you are ready then to go through the conveyancing process and let it out and do the refurbs, which is a whole different world. But hopefully this video gives you an understanding of where to start, the processes of where to start. It can be overwhelming for some people to start with anything new, but we break that down. We go through it methodically, we do the work, we set out some KPIs, and we hold your hand through the process so you can understand how to start and where to start and start making money from as little as like next week. If you go through the processes and the steps that we teach you, you'll be able to start selling deals on and make 5k plus at a time. We're looking at selling 5 or 6 deals a month at the moment. It's good revenue, and then when the revenue fits, as in we make enough, we'll buy them for ourselves. So property is relatively simple in terms of how to do it, but it isn't easy, and it takes a little bit of work time to understand stuff. So I'm here to help you. I've hoped you've enjoyed this sort of introductory and help video to start you getting going in property, and I look forward to speaking to you a little bit more.